All right, now we move from the St. Louis market to the national market. We're pleased to have with us today Mr. Ross Moore, Director of Research for Colliers International. We thought it'd be great to have Ross speak about the national commercial real estate market. Many of you own properties all across the country, or you have locations across the country, and knowledge about the commercial real estate market is always great at a cocktail party. So, Ross is here. He's got a great perspective on the marketplace. He's been at Colliers since 1993, and so this isn't Ross's first rodeo. He's been through the ups and downs of the marketplace. Ross works with all our Colliers International partners across the country, so he's got great market information. Ladies and gentlemen, Mr. Ross Moore.
Thanks, Dean. It's always tough being the last speaker. I unfortunately have the job of delivering a pretty somber message. As Dean mentioned, I track the entire country, about 56 metros across the nation, and it's clear that pretty well every region of the country now is in a pretty bad recession. We're going to get some pretty bad news tomorrow morning with the jobs report. But this recession is clearly turning into one of the worst that we've had in quite some time. And almost without doubt, it will be the longest recession that we've had since really the Second World War. But I'm also reminded that recessions don't last forever. And there's an old saying, on the way down, no one can see the bottom, and on the way up, on the way up, no one can see the top, and on the way down, no one can see the bottom. And I kind of feel that's where we are. It's not to suggest that this recession is going to end anytime soon. I think there are too many things working against us. I'm going to work through many of those. But the point is that there's a lot of strife out there, and things will unfortunately get worse. What I really want to do today, though, is I'm going to run through the office and industrial report at sort of a macro level, highlight a couple of markets, but I really want to focus on the latter part, which is really what's going on in the economy and what can we expect for the balance of this year and indeed into 2010. So let's go to the first slide and look at office absorption. And this graph sort of sums it all up. We had a great 3-4 year period. So you can see there we're averaging 20+ million square feet of absorption per quarter. This comes after the tech meltdown in early part of the decade. And then really starting early last year, absorption pretty well went to zero. It kind of bumped around. And then you can see on the far side there, Q4, negative 11 million square feet. So I think like the economy, it really started to slow in the last quarter of the year. Just a word of caution on the absorption numbers in the fourth quarter is 11 million, but Manhattan is approximately 5 of that 11. So pull out Manhattan and the numbers don't look quite so bad. But the point is that there is certainly little or no demand for office space nationally, a dramatic rise in sublease space. And just talking about sublease space for a moment, we have seen a pickup, not dramatic, but it is starting to increase, and we do see it going higher. Probably not back to the levels we were in 2001, 2002, when we had a significant amount of pre-leasing. The national average is around 11%. So 11% of all vacant space in the country at the moment is sublease space. Huge range, depending on what city. Interestingly, Midtown Manhattan, 30%. So 30% of all vacant space in Manhattan right now is on a sublease basis. I think here in St. Louis, we're certainly in the low single digits. So very, very different. Okay, vacancy rates. You can see the vacancy rate is on the way up. We will probably see the national vacancy rate go up at least 2%. So we're sitting at 14%. At the moment, we're going to finish the year almost certainly at 16, and I can see it being at 17%, which takes us back pretty well where we were earlier this decade. What's interesting, though, is you look at office or CBD and suburban, they're being driven by different factors. The suburban market, sure, the demand's not there, but it's new construction. We've got quite a bit of new construction that was started 12, 15 months ago that's still coming on. So that's really pushing the vacancy rate up. Downtown, we're not really building a lot, but what we are seeing is a return of space. So sublease is really driving the downtown vacancy rate up, and suburbs, it's construction. Okay, rents. Not surprisingly, rents have turned down. And I do need just to comment on the CBD. You can see it dropped quite sharply there. It fell actually 7% in the fourth quarter alone. And it's two markets that really pulled things down. Manhattan, again, but San Francisco. San Francisco rents came down very, very sharply. And I think it reflects some absolutely top-tier trophy space where they dropped the rents dramatically. I'm hearing numbers in New York where the top rent achieved in buildings was, let's say, 120. You can now have that rent for 60. So huge, huge drop in Manhattan. It's pushing the national numbers down, but I think it's fair to say that we're going to see rents come down more over the next 12 months. I think downtown rents will easily come down 15% and suburbs around 10%. Okay, moving on to industrial. Same sort of pattern, great run, 3, 4, 5 years. And then really starting last year, it started to come off a little bit. I think with the benefit of hindsight, the one thing I've learned from this cycle is that housing is very, very important to industrial. More important than I thought. It was certainly one of my top 5 drivers, but housing has really, again, with the benefit of hindsight, I think had a large part to play in what's going on in the industrial. Same kind of story with industrial as office in the sense that we had negative 18 million. So that's a big chunk of space that was returned to the market in the fourth quarter. 18 million square feet, but a couple markets in particular. Silicon Valley, huge, huge negative numbers, and also Atlanta, 2 markets that combined were around 5 or 6 million square feet. My point is that you've got to be so careful with these national numbers because both with office and industrial, there are a couple markets that are really affecting the national markets. My surprise, to be honest with you, in this cycle is that we obviously have a terrible economy. I think commercial real estate has held up remarkably well. If you go to the non-California, Arizona, Florida, we know the states that are hurting, and maybe New York. I mean, that's the other big market. You pull those out, and I think the country nationally is actually doing surprisingly well. Okay, let's move on to vacancy rates. We can see here, bottom, we drop a point. I think on industrial, we're going to probably jump another 75 basis points, probably a full point by the end of the year. Interesting with industrial, construction has almost gone to zero. We're forecasting less than 75 million square feet of construction in 2009. 2008, 176. So a dramatic fall off in construction. I think that's really going to help. But obviously, we're not going to have a whole lot of demand this year for industrial. Okay, let's move on to rents. So on rents, same sort of idea. We had a great run up, rising about $1. We've come off. And I think my sense is that the declines in rents are starting to increase, so I can see industrial rents coming off quite sharply. What was interesting in the last quarter was it struck me how I think we track around 18 different markets in California. 17 of the 18 saw rents drop in one state. I mean, pretty well the entire state came down. LA, really sharp drop in rents. Arizona, Phoenix was hit badly. Nevada, Reno, Vegas, and then all the Florida markets. It was quite striking to see those markets see a big drop in rents. Okay, let's move on. This is my attempt at humor, so I'm going to try to talk about the economy, but that's about as funny as it gets. Let's go to the next slide. GDP. So obviously last week we got the advanced numbers. 3.8% decline in the fourth quarter. I think, unfortunately, when they get revised the second and third time, almost certainly the GDP numbers are going to be reduced even further.